Hi, we're here at the 2022 University of Virginia Investing Conference. And Michael, during your talk, you spoke a lot about kind of the connection between liquidity and both real economies and public markets. I wonder if you could help us understand kind of where we are right now and where we may be going next.
Okay, certainly. What you need to do, first of all, is to distinguish money that's in the real economy from money that's in the financial sector. The two are pretty much distinct. And what we're primarily focusing on is the financial pool of liquidity, which is driving financial asset prices. Now that could spill over into the real economy for sure, but that's a subsequent event. So let's just look at that cycle and how it's moving. What you've seen since probably the beginning of 2021 is the emergence of a peak in liquidity. So liquidity was fueled up significantly through the COVID crisis. Central banks were injecting lots of cash. It reached a peak around about the early part of 2021, began to plateau, and effectively since late 2021, it's been coming down, but through 2022, much more sharply. So at the moment, the global liquidity cycle is pretty much at a trough. It's been hit by a number of factors. One of those is rising inflation, which has pulled money into the real economy. Higher oil prices saps a lot of liquidity. Central banks have been squeezing enormously. So that's, again, provided downward impetus. We're pretty much now at the trough. And what we've got to expect in the next 12 to 18 months is for the liquidity cycle, which tends to have a frequency of around 5 to 6 years, to begin swinging up again.
Understood. And do you think that, without putting too fine a point on it, does your research yield any kind of forecast where markets might be going or economies might be going, given that there are profound impacts on those two things from the liquidity cycle?
Correct, absolutely. Liquidity tends to lead financial markets by between 3 and 12 months, depending on the asset class. So if you look at the fixed income markets, that tends to have an immediate effect. So you'd expect to see factors such as the yield curve respond to tightening liquidity by flattening and probably inverting. That transmission occurs through a wonkish concept called term premia. So term premia become compressed as liquidity conditions tighten. As liquidity conditions expand, then term premium begin to increase again, they expand, and the yield curve will steepen. We haven't reached that stage yet, but that's one thing to look at. The next stage on from, let's say, fixed income will then be the equity markets. The equity markets tend to follow maybe about 9 months after the initial squeeze in liquidity. That's a bit of a variable horizon. Many people have been watching the Fed very closely in the last few weeks and months. So actually that time, that sort of time gap has narrowed somewhat. But generally speaking, equities around about 9 months after the liquidity squeeze, they tend to come down. That is a dual effect, first of all, from the impact on multiples, and then the subsequent impact from the real economy as the real economy starts to hit earnings. Now, the earnings factor is the last, if you like, the last part of that chain. Earnings on the real economy tend to be affected negatively by declining liquidity around 12 to 15 months into the future. So the stock market is always anticipating that, so it's getting there first. But essentially what you would see is fixed income markets first, equity markets second, real economy third, and the real economy tends to be hit 12 to 15 months after the initial liquidity squeeze. What is coming is likely recession. What is happening in the fixed income markets is we've had the front end of the yield curve elevate significantly. The back end has been pivoting down as the yield curve has flattened. What I would expect to see in the next few months is the beginnings of maybe the front end coming down and the back end of the yield curve steepening. So you'll get a more normal shaped yield curve over time. It may mean that actually the long end doesn't move that much in practice from where we are now, but the front end will come down, the yield curve will steepen. Equity markets will find a bottom, but that may be 15% or so lower from where we are now, but we're getting close to that bottoming out process. But sadly, the backdrop for the real economy is not good.
Lots to think about from the 2022 University of Virginia Investing Conference. Michael, thank you very much.
Great pleasure. Thank you.